and unusual expenses as well. And it's divided by book equity. That means it's similar to return on equity in its spirit, but instead of using net income, we're using operating profits. So it's like an operating return on equity. So scale is not an issue. All right. To kind of link ourselves to a discussion we're going to do after fall break, let's kind of think about why there may be an issue, there may be a pattern with small stocks. What's the difference between smaller stocks and larger stocks? Let me reopen that file. Basically, it says the smaller is the stock, the riskier it is. But on the other hand, the smaller is the stock, the more money you should expect to make. Let's go back to the risk issue. Just out of your own intuition or experience, why should small stocks be riskier? At the end of the day, a lot of people actually invest into small stocks. If you think about it, venture capital firms, they invest into tiny stocks. When Google first started, they were basically the Google guys and a secretary. But they got a lot of venture capital or angel investor money in. They're now worth over $1 trillion. So why do we consider them risky?
Because there's a lot of potential.
Hmm?
There's a lot of potential.
Well, that's the upside, but part of the risk is also the downside.
Like, see the market cap's lower, so they try to expand a little more vigorously, which can make some decisions that are a bit more.
Think about it this way. If something really bad happens to the economy, who's likely to go to bankrupt? A small company or a large company? Small company. And part of the reason is not necessarily, you may have a small company that manufactures computers, you may have a large company that manufactures computers. The change in the economy is going to affect their business exactly the same, at least the sell side of the business. But just like in a business, you need funding. From the viewpoint of a equity investor, they may not look that different. But from the viewpoint of a lender, they actually look different. Because I'm a bank and I lend you $10,000, you don't give me anything of the upside. Let's say I actually charge you a lot of money. And typically, smaller companies pay a lot higher interest rate compared to larger companies. Let's say 12%, which is roughly the average interest rate for junk bond these days. If things go well, you're going to pay me 12%. But if things go bad, I'm going to get some haircut on that loan. Maybe lose everything. Because on the other hand, a large company, they are a lot more likely to survive. Hence, I would be more willing to lend money to them. So there's kind of a financial distress component in that. And in many cases, fluctuations in the economy, even without financial distress issues, affect smaller companies more. I mean, think of Google in 2004 versus now. okay, before they had YouTube and everything. If the economy tanked, who's going to be affected more, Google or Microsoft? Yeah. Microsoft was and still the largest company, and the economy did tank in 2008. Who got affected more? Obviously Google, because they're smaller companies. And they had pretty much one reliable business at the time. It was getting ads to those searches. Later on, YouTube, they started way of making money off of YouTube. If you look at it, let's look at what happened in 2008. Let's do a chart. Let's do max. Come on. What happened here? These are the splits. Let's see. Before the crash, on an adjusted price basis, Google was trading about $17. By middle of 2009, they were trading at $8. And at that point, Google was not that small of a company. The word Googling was already in English language. And let's add Microsoft to the comparison. Let me use a different color, red. Microsoft was trading around $34 at the end of 2007. By middle of let me see, it was trading at 16. It was also affected quite a bit, but not as much as Google. So there's kind of a rationale for smaller companies to be riskier. Now let's think about operating profitability companies, or operating profitability deciles. Let me change that. I'm going to call this operating ROE. In terms of risk, it probably is not surprising that companies with low ROE are riskier. If you're not making that much money, that means you are not as likely either A, to survive, or B, even if you do, I'm not going to see those in your financials, so market is not going to reward you. So the fact that they are riskier is not surprising. Companies with high ROEs are not as risky. In fact, the difference is quite a bit. 341 for the most profitable versus 479. On size, 325 versus, it's similar. So that part is not necessarily surprising. But this is kind of a little bit surprising to me, at least on paper. It looks like, let me see the difference. Let's think about 9 and 10, about 13, average of 13 or so. 1 and 2, 10 and a half. So if you think about it, if you think about operating ROE premium, it's about 2.5 percentage points. Let's look at the same number for size in the same period. Let's see. Let me change that to